Kick this off. So today's session is open for like new people who are kind of new joining us and also people who are not so new joining us. So we'll kind of go over some of the basics. And we had gone through a lot of Nelson Nash's book, who's the creator of the concept, like the infinite banking concept, which again is just being able to use whole life policies in a way that normally had not been used up to that point, and being able to allow the use of the policy funds to be able to grow in the policy and then also be able to be leveraged and used and borrowed against to be able to use it for other things. And so the section that we're going to cover today is kind of like, what are some of those things that you might use your policy cash value for? And so first and foremost is kind of just understanding that when we're taking a loan against the policy, we're doing exactly that. We're saying, okay, we're going to fund our own system, kind of cram money into it. And then as we have need of funds or desire of funds or whatever, whether it's for, all sorts of different uses, which we'll kind of get into today. So whatever you're using those funds for, when you have a loan against it, it allows the policy to continue to still earn the guaranteed interest and then also keep earning the dividend. And so it allows it to still continue to compound and grow, even though you're using those funds and borrowing against it for X, Y, Z, and everything in between. And so being able to have that system in place allows you to have that growth curve that is not interrupted. It allows it to still continue to compound. And that's one of the main benefits of the policies, is that in addition to the fact that it's growing tax deferred, you can actually access it tax free. I will mention a caveat here. We talked to a client of ours, which I have to be very clear in the language on this. So there's a client of ours that she actually had another agent not associated with us who had signed her up and put together a policy for her about a year and a half before she started working with us. And she recently utilized her policy to actually pay off the remaining small balance that she had on her home. And so she basically kind of refinanced her mortgage and used the funds that she had in the policy with us, the policy that she had with him, and she took out a loan. And then she got a tax bill from that company. And so she'd contacted us and was like, why would I get a tax bill? And we're like, well, I don't know why you would get a tax bill. You should not get a tax bill because it should have been set up properly. Was it set up properly? She went back to that agent and come to find out it was not set up properly.
No.
Guys, it matters who sets these things up. And so she's, upset because she's like, I thought that this was growing tax free, tax deferred. Why would it even be set up this way? So just to be clear, you can use whole life policies. You can borrow against it. You can do all these things. You can actually, get a 401k version of like a whole life policy and actually have that be where the money goes into and have it still have the tax treatment of a tax deferred account. So they do not always get set up the way that we set them up. So I'm saying that just because those of you who are new, not everyone is equipped to be able to have the experience, the knowledge, the know-how to be able to handle these kind of policies, to be able to set them up correctly. So we're now helping her to not unwind. You can't unwind. Once a policy becomes a MEC policy, which means it's now taxable, it cannot change tax treatment suddenly. So once you violate that, you have a short window to clarify and to correct that violation, which we're always notified if somebody does it accidentally. So if you're a client of ours, we will be notified, you will be notified. And so you have a window to correct that mistake should you make it. I have done that on my own policy on accident.
And I guess we should say the reason why it does happen for most of our clients is they overpay. And it's because of that. And it's a simple, all right, let's just refund you back the amount that you did. So,
Well, they're doing well enough to overpay, which is great.
yeah,
Right.
I mean,
Yeah.
yeah.
But now this window, in this case, did she receive a notification but didn't understand what it was?
No, in her case, she found out that the policy was never set up to have the tax advantages that she thought it had.
So can
And
you,
so,
oh, good.
yeah,
So
anyway,
she is stuck in the present time situation, but can this be altered for the future, for what's left on this?
no. So we're going to be
Okay.
doing some damage control and be meeting with her and strategizing with her to try to get things corrected and to get things moved around and do things to kind of shift funds into our policy, which is set up correctly. And
That's
so
right.
anyway, so just understand that not everybody sets it up the way that we do it. So sometimes we'll have people who will come to us and they'll say, "Oh, I have an insurance person and they said that they can set this up." It's like, please do not. That's like taking your car to a guy who's like, "Hey, I think I know how an engine works. Can you let me work on your car?" It's like, please don't trust your financial situation to somebody who's just dabbling in this or who they do something else and they kind of know how to set this up because they can kind of mess you up and not intentionally. I don't think that the agent had bad intentions with it. I really don't. I think they just did not know what they were doing. And so I think they may have thought they set it up correctly and it was not set up correctly from the beginning. So
And
she
your
found
So
out.
and your client,
there's only so much building you can do on the foundation you laid down originally.
Exactly. So I
and
mean,
the,
if your system, if your vehicle is bad, then everything that is built upon it, it can only be as good as the vehicle that you're putting it in. And so, and we'll move on from that. I just wanted to let you guys know that what
Yeah.
we do matters, and you need to have somebody who this is their specialty because it does matter and it can, you know, it can trigger things. And every time that we've had a situation where somebody has either, like in my case, I actually, so all of you that have policies, you understand that when we put a policy together, you have a maximum that you can put into it. If you try to put in more than that maximum allows you to put in by contract, then that violates that corridor and it becomes a MEC policy, which now makes any of the earnings taxable instead of having it be tax free. Okay, now in my case, what I did is I accidentally made a payment and I classified it as if it was new premium going in, and I meant to actually have it be a loan repayment. And so in that case, then they sent me the letter and I was like, wait, what? Did I really overpay? I didn't mean to do that. What happened? And then I went back in and I looked at what the amount was and I went, oh, I meant to classify that as a loan payment. So I was able to contact them and have them just reclassify it as a loan payment and it took care of it. The other option, if you did do that on accident, is they'll then say, what do you want us to do? Do you want us to mail the check back to you? Do you want us to still deposit it into your account and then now it'll be a MEC policy from here on out? Or do you want us to apply it to the loan? And so there's a lot of different ways that they can remedy that situation. And I only bring that up just because that literally happened this week. And so I just want you guys to be aware that that can happen. And, you know, and so that's why we have protections in place. That's why we set up the policies the way that we do, is to keep and prevent those things from happening.
Christy, question. How do you know what the maximum that you can put in is on your policy?
Good question.
Great
On your
question.
policy illustrations, every single one of you, if you don't know where to get your policy illustration, if you are with
correspondent.
Penn Mutual, you can actually get that straight from your dashboard. And so it's in the correspondence section and you have, it'll say view illustration. And so you can view it there. If you are with Mass Mutual or Guardian MTL, I'm trying to think of who on these calls is on which kind of policies. I think I covered everybody on this call as far as which carrier you happen to be with. Then you would either have it on your dashboard. So on the illustration itself, it will show you what the maximum amount is. And so whatever you're seeing on your basic ledger, that is your maximum amount. And so
Is that maximum annually or
yes,
total or what?
yes, maximum annual amount. Yep.
And it
And
looks like a little
does,
eyeball. It looks like an eyeball icon to view.
does it also give a total maximum?
Um, Not necessarily. So everything is based on an annual maximum. So you have an annual amount that you can put in maximally every year. And if you surpass that, then that's when you would get that. Now, the other place that you can tell is when you go to make a payment, you almost have to do it intentionally to put the payment in, to be honest, because if you put it in, if you go on your dashboard, for example, and you're making a payment with any of these carriers, it's going to tell you how much you can put in toward paid up addition. So if you put in more than that specified amount, it will allow it to take place. And so just look at what the amount is on your dashboard and it'll show you what your maximum is.
Now, the term itself is rather interesting, a modified endowment contract.
Mm-hmm.
That would be worth breaking down sometime. Well,
Yeah.
when you think about it, it's like endowment. It's like, I thought I just paid a premium. You know?
Right. Right. And so there's some tax protections, which is the reason we're setting these up, is because we're trying to maximize the cash value that you have in your policy, which is the usability that you're going to be having access to use, having liquidity to be able to use. Now, when you're not using it, the insurance company is still going to be using it and they're paying you a dividend for using it. And so it's going to grow whether you use it or not, I guess is what I'm saying. So that's the other caveat that I want to kind of place before we kind of touch on. I'm about to share my screen here in a second, but before we get into this, keep in mind that don't feel like that because you're not utilizing your policy cash values that you're not growing your policy. It is growing fantastically well while you're letting the insurance company use those funds and pay you a dividend for using those funds. So don't feel like you're missing the boat by not getting into like risky investments or things like that. So I want to caveat it with that and also say that just because you have access to use the funds doesn't mean you always should. And so we'll touch a little bit about that as well. And then any questions that you guys have specifically, we should have some time at the end where we can get into that as well. So anyway, so that's kind of the plan of attack for.
Christy, I have a very, very simple question just to clarify.
Yeah.
If you have $100,000 cash value in your policy and you take out 10,000 to buy something, are you getting paid dividends on the full 100 or just on the 90 that remains?
So you're getting dividends on both. And again, depending on which carrier you're with, they treat dividends a little bit differently. So like the majority of you that are on here that have policies with us are Penn Mutual policies. With Penn Mutual, they have something called a split dividend. And so on the portion that you took out, you're still earning most of the dividend. It's actually 77.5% of the dividend that you're earning on the portion that you took out and used for your purposes. Okay. Now on the portion.
So back to the example, I started with 100, I took out 10.
So on the 10.
Well, excuse me. Actually, you didn't take any out. You borrowed again.
I borrowed. Yes.
That's why what remains continues to grow. See.
So the 90,000. So yeah, Walter, to kind of go back to your question. So the 90,000 that the company is using, you're earning full dividend on that, and you're earning 77.5% on the 10,000 that you just borrowed against and took out to use for whatever you wanted to use it for.
Okay.
Now that is only for the first 10 years of your policy. From year 11 on, Penn Mutual says, okay, now you're kind of vested. So now you're going to earn full dividend on the loaned portion and the non-loan portion the same. So that's how they treat the dividend.
Even if you never repay a dime of that loan.
Exactly. They're paying you full dividend either way, which is one of the reasons why they've become one of our preferred carriers in the most recent years, is because we like how they treat the dividends. And we like the fact that when you're in your later years and you're using those loans for actually using it for retirement income, you're receiving full dividend, whether you have a loan out or not. So we like it for that reason. It becomes really fun. Yeah.
Why would you risk the market when you understand that? It's just amazing.
Yeah. Well, and really that's kind of what it boils down to, is that you can take the market volatility up and down, or you can just have the consistent steady eddy that the policy gives you and allows it to just compound and continue to grow. So you can kind of take your choice. Now, people who like to do market stuff, then you would want to use your policy as your base camp, borrow against the policy, and then still do whatever it is that you're wanting to take the risk on. And then you now have the policy that basically is kind of the safety net underneath all of that. And so if you like to take risk, that's fine. Our recommendation is, we're usually trying to talk people out of taking risk, quite honestly, because our message is that you don't have to take the risk in order to get ahead. If you want to take the risk, that's different. But if you're doing it because you financially feel like you have to, then we need to show you how we can help you to take less risk, because you don't have to take that kind of risk if you don't want to.
But doesn't it like wash itself out? Like if you're putting it in the market, if you're using your policy and you're putting it in the market, and even though it's growing here, you still have to pay gains on the stuff that you earn in the market anyway. So you're sort of washing that earn, maybe not, the market grows much at a higher, steeper rate, but you're washing away some of your profitability anyway, because you're going to have to pay taxes on the gain.
Right. And I think that's the other part to that, is that sometimes we get so used to being raked over the coals with taxes on how much we lose, that our rate of return that we're trying to get is automatically higher in our minds, because we know that we need to get a 9% in order to get what is left to us after taxes are taken out. Right. So I want you to ask yourself the question, if I did not have to factor in taxes, what kind of rate of return do I need to get? Now, for everybody, that's a different answer because of what your tax bracket is. So somebody who's in a much higher tax bracket, the rate of return that they would have to get is much higher in order to equal what they're going to actually net after the taxes are taken out. Does that make sense? So let's use an example. So if you've got $100,000 that you just made, and you're in a 10% tax bracket, how much are you going to lose in taxes? 10%, which is $10,000. If you're in a 32% tax bracket, how much are you going to lose of that money? It's a different number depending on what your tax bracket is. Now there's state and then there's federal. Now it depends on what you're going into. If you're going into like an investment, then the first 100,000 that you put in, let's say, then that is your basis. So that part is not taxable. The gain is the part that is taxable. So it just depends if it's tax deferred, which would be like a 401k, none of that has been taxed at all. And so when it comes out, all of it is taxable. So sometimes a portion, which is the gain, is taxable, and sometimes it's the whole thing that is taxable, depending on what it is that we're talking about. But either way, the higher your tax bracket is, the more important these policies become to you, because you understand that your leakage to the tax person is going to be a lot less. You're going to retain more than if you're in a 10% tax bracket. So sometimes people will refer to these types of policies that we set up, they'll refer to them as like a rich man's Roth, because you can use it for whatever you want to use it for. It's like a rich man's self-directed Roth. That's actually probably a better way to classify it. So when you understand the power of it, it helps you to understand like what it actually is. And there's so many different ways that you can use it. So, okay, so I'm going to share my screen. And Shane, I have a favor. You know what we're going off of for this, right? Like the list of
Yes.
Do you mind going to that? And when we're done, I'm going to have you go to that, and I'll have you share your screen just with that on like one page, because this makes it fancy and nice looking. But just in case you guys want a list at the end, I'll have you do that if that's okay.
I will pull that up.
Okay. All right, you guys, we use some fancy stuff over here. We've got a guy on our team that does a lot of AI stuff, and so he's opened our mind with AI. So this was not me that created this, but this is still pretty cool.
It looks pretty
Like
fancy.
the temple.
It looks fancy.
Super fancy. Yeah, it totally does. Okay, so this is kind of like the private banking playbook. Oh my gosh, I can't even say that word. I am still recovering from a head cold, apparently, and my brain fog is getting to me. Okay, operationalizing the infinite banking concept. So this is kind of going to give a little tiny bit of an overview on the concept, but mostly on looking at policy uses and where it comes into play. We're going to cover different ways that people use the policies to be able to do all these different things. Okay, so we're going to talk about a few different phases of how you can use it. So number one, you're kind of putting money into the policies, and that's kind of your foundation. You're kind of laying that as your foundation. Now, as you're only able to borrow against what you're putting into the system, right? So if you put $100,000 in, you're not going to all of a sudden magically be able to borrow 500,000. That's not the way that it works. It's you capitalizing your own system, and then once it's there, then you have that to be able to use it for different things on whatever you want to deploy the capital for, okay? So in this case, we're going to kind of cover each of these, but the first layer, which I think is really cool that it does it this way, is a security layer, okay? Then we've got growth, and then we've got legacy, and we're going to talk about kind of the uses of the policy in each of these. So hopefully I can do, there we go. Okay, so you're going to think of your banking policy as your hub, okay? So you guys have heard us reference this. Those of you who've been around us for a while, you know that we basically say use that as your foundation, okay? So what does that mean? That means, hey, if I put my assets and everything into the policy, and then whatever I want to use it for kind of comes back out of the policy. Now, we're not saying, there are some people that will say put every dollar into the policy and then take every dollar back out, okay? We don't really play that game where we are. We kind of say, okay, take a good amount of what you have and put it there, but whatever's going to stay there is kind of what you're leaving there. Now, this gives you a place. My dad uses a good analogy where he says, you know, if you have a Ferrari and you have a nice car, where are you going to keep it? Are you going to just park it right outside your house, or are you going to have it in a garage?
Yeah. Garage.
Okay, why do we have it in a garage? Because we want the safety, we want the security, we want to make sure that it's protected. It's the same thing with your money. So we're basically saying, okay, we're going to treat the money that we have and the assets that we have with that same respect. We want to house it in the policy until we want to take it for a joyride, okay? And so now sometimes those joyrides are going to be different things. So these are kind of different things that we might use it for. Now, it had on that last page the security side. Okay, our personal belief is that if you have debts that are outstanding, now when I say debts, I'm not saying your mortgage, okay? I'm saying other debts. So you've got unsecured debts, you've got consumer debts. Those debts are killing you. And if you look at what the interest rates are on those debts, you want to be able to get that under control. So that's the first layer to your foundation, is to say, okay, let me tackle my debts, my consumer, my all of those kind of things. So think about in your own situation, like either in your life now or in your life, like even 5, 20 years ago, whatever the case is. Okay. Now, who usually is making money on you when you need to buy a car, when you need to use a credit card? Who's making money on that interest that they're charging you?
Not us.
Okay, not you, right? So the whole point is to be able to say, okay, as you build your system and you're putting money into the policy, then wouldn't it make sense to then borrow against that policy, let it still be compounding and growing, but then use that to help you to pay off the debt faster, so that way you have a lower interest rate and you're able to tackle that debt in a quicker speed. So those credit cards can kill you pretty quickly. You can feel like you're spinning your wheels. And so if you have debts that are like, especially consumer debts. Now, first of all, I know I mentioned an example a couple weeks ago about somebody that we were kind of working with that, not kind of, somebody that we're working with that they were contemplating a bankruptcy situation because of the amount of unsecured debts that they have. Okay, you guys, if you guys are drowning in debt, let us kind of go through that with you and help you kind of figure out different solutions. So if it is manageable, and it makes sense, then it's something that you would want to use your policy for, to be able to say, okay, I've got $100,000 in cash value in my policy. I'm going to borrow 20,000 out, and I'm going to pay off my $20,000 in credit card debt, or something that's kind of, higher interest rate.
Or
Okay,
student loan debt or whatever the heck.
Okay, so this is basically debt restructuring, which is basically where you become the lender and you take over that debt. Now, let me ask you a question. If you take $20,000 out of your policy and you pay off the credit cards, then what's the responsible thing to do?
To pay off the policy loan and
Okay.
not charge anymore.
Okay. If you do not refinance that debt and actually have the payments go back into your policy, then what did you just do?
If what? If we didn't pay, if we don't, what?
Okay, so if you take out a policy loan for $20,000 and you pay off the credit cards, and then you don't pay back the policy loan,
Oh,
what did you just do?
You're robbing from your future payments in retirement.
Okay, and you guys, here's the deal. The insurance company, when you take out a loan, they don't care if you pay it back or not. So this is where the self-discipline part comes in. So if you use those funds and you use it for paying off the credit card debt, and then you don't replenish and pay back that credit card debt balance, you didn't refinance your loan, you just robbed from your account.
Even then, you still have to pay the annual interest on that loan.
You don't have to. It'll compound and kind of go against the cash value if you don't have to. You should.
Well, true. Yeah.
You should.
Okay.
But my point with that is that if you're going to refinance the debt, truly refinance the debt. Treat
Yes, or
yourself
else,
with the
because
same
if you don't-
respect.
Right.
Yeah.
If you don't
So
pay
treat-
off that interest, then it goes against you more quickly. You have a compounding debt.
Yeah.
Okay.
So, and the bottom line is this: if you do it the right way, and when we say become an honest banker, this is what we mean by that. It means that if you're going to borrow from your policy and use that to pay off a higher interest debt, then you should do one of two things. When you're paying back your policy loan, you're either doing it ideally at the same rate that you were paying. So if you were paying out, $500 a month toward that $20,000 credit card debt, then ideally you'd say, hey, I'm okay with that budget amount. I was just not making any headway. So I'm going to take that $500, I'm going to pay it back toward my policy loan and get that balance down to zero, which is going to pop my cash value and availability back up again. That's the proper way to do that. Now, if you need a little bit of reprieve, oh, go ahead.
So back to my earlier question. So you take out that loan. If you don't repay it, you're still getting the dividend. That's going to help offset some of the interest that the insurance company is going to charge you. So
exactly.
I mean,
you are still moving forward. You're just not moving forward as much as if you replenished and paid back the loan. But yes,
or maybe it is also true that your total cash value is declining, but not as much as if you weren't getting the dividend.
Exactly, because you're still putting in new premium. You still have other funds that are there. It still is growing. Don't get me wrong. It's just not going to grow as well if you don't ever replenish it.
And it's not, and it's growing, but when it comes time to getting payment in your retirement, that amount's going to be less too. And I don't know, my biggest concern was having debt tax-free income in retirement for whatever happens to come up if there's any kind of medical need or whatever. So yeah, you don't have you might feel like you're getting away with something by not paying it back, but you're only robbing from yourself for later.
Right. And so, but you're right, Walter, like you've got a delta in between there. So you've got the values that are still growing. And so you don't need to put it back. You really don't. And it really depends on a person's financial situation. But if
And
you
I'm
really have,
my assumption was you're no longer paying premiums into the account. It's fully funded, it's growing, and then all of a sudden you take a loan out, you never repay it. So two things are happening. You're still getting the dividend, but then the insurance company is charging interest. So it's going to decline, but I guess the question is how rapidly does it decline?
And your death benefit goes down to your heirs. So the insurance company is going to get their money back. They'll just take it either at the end or as you go.
Yeah.
Right?
So Walter, let me come back to yours here real quick. So yeah. So and here's a reality. And most of you probably remember when we went through your policy illustration, those who have policies, we went through and we showed you what does it look like if you take cash out? What does it look like if you take a loan out? If you really have no intention of ever paying that back, then you would be better off to just take it as a withdrawal, which is why when all of you get to a certain point and you're in retirement mode, we're going to withdraw first and then take loans after that, right? Now, that's on purpose. We design it that way so that it can give you the most squeeze for the money that you've put in versus what you're getting back out. So if you really have no intention of paying it back, then you would do a withdrawal. But we would usually tell you to reserve the withdrawal option until you really have no intention of paying it back and you're kind of done capitalizing and funding your policy. Either of those two circumstances. So there are circumstances where that applies. Most of the time when you're in your accumulation phase and you're trying to grow things, then you want to take it as a policy loan and not as a withdrawal so that you can put it back. Because to your point, Walter, that difference in that spread is like 0.65% that you're kind of like at a negative or like a true kind of cost of funds on that amount. And so if you really didn't ever intend to ever pay it back, then you'd be better off to do a withdrawal. But if you think you might want to pay it back or you have future funds that you're like, you know what, I'm kind of taking out of 401k stuff later and I'll be able to pay it back even if it's 10 or 15 years from now, you're better off to actually take it as a loan.
You can only withdraw to the point the max you can withdraw is the amount you put in, right?
Right. Yeah. And actually 95% of whatever your cash value is usually the amount that you're able to take out or withdraw or yes. And same thing. Oh, I know what you're talking about on your basis.
On the
So
basis,
the amount
yeah.
that you can actually take out on a withdrawal, we only want to take out up to the basis amount. And so let's say that over the years you've put in, $300,000 into your policy. That's how much you've actually contributed into it. Now let's say it's worth 600,000. Okay. That 300,000 that you very first put in, the only amount that we're going to have you withdraw is up to that basis, because anything above that would be taxable, and that's where we're going to turn to a loan.
Right.
So you're
Right.
exactly right.
Right.
Yep. Yeah. Okay. So debt restructuring is one. And okay, Rip, sorry, let me read that. So buy back the debt from the bank or credit card and continue to make the payments to yourself. Yes, exactly. So if you're refinancing and restructuring that debt, now if you need some reprieve, if you're like, hey, I paid off the $20,000 in credit cards and those payments were killing me at $500 a month, then feel free to slow that down. But just do something to where you're being dedicated and kind of replenishing your own system. Because if you're taking those funds out of rotation, and not out of rotation, it still is earning and growing. But if you're taking it out and using it for something, in an ideal world, you'd be taking it out and using it for something and then putting it back so that way it allows it to give you that much more in tax-free income when you do retire. So you want to be disciplined about that if at all possible. Now, I will say that there's been times where I've used this for debt structuring, like I've used it to pay for LASIK eye surgery. I've used it to pay off student loans. I've used it to pay off credit cards. I've used it for buying a truck that was a salvage title that I couldn't get financed somewhere else. So I've used it for my own, debt or my own uses. I've used it for, debt refinance. And there's been times where I couldn't afford any payment because times were tough or things were tight. That's totally fine. In cases like that, just understand that when you're putting the money back, the insurance company doesn't care whether you put the money back or not. And so that's up to you. So all I'm saying is that even if the payment plan that you're setting up with yourself is to say, hey, this year things are tight and I've got bigger fish to fry, I'm not going to make any payments toward that policy loan yet. That still is a game plan. You might say, hey, next year, then I'm going to start doing $200 a month because I have a raise I'm expecting, or I have this debt that's going to also be paid off, and then I'll have excess funds. Just have some sort of game plan with yourself so that you're not robbing from your account. You're literally borrowing from it and helping to make your system better. Try not to just be a consumer. Try to just be smart about recycling the funds and replenishing them. And that's really kind of the whole point with that.
And you may have already said this, but so if you have the option of doing paid up additions versus paying the loan.
Yes, I would do paid up additions first before I would pay toward a loan. Absolutely. Because you're going to be earning full dividend on the portion that you're putting in on the new premium going in, and you also only have that year to get it in. And so once you've passed that year, you can pay back a loan anytime you want to. You can only put in that maximum amount for that policy year. So you want to put in that paid up addition and kind of satisfy that so that it allows it to continue to grow and keeps it growing at a good speed and pace. And by the way, actually raises another question. Sometimes people will like borrow in order to put in their full paid up addition amount. Don't feel like you have to do that. With Penn Mutual, if you have Penn Mutual, you have a catch-up provision anytime from year 3 on, where let's say that year 1 you put in 10,000 that you could put in. That was your maximum. And then year 2 you put in 5,000 because you were trying to kind of pay down some high interest debt or something, or things were tight. And then year 3, now you're like, okay, I've actually got plenty to put in. You can actually put in the full 10 that you were allowed to put in for that year, plus you can put in the 5 that you did not put in the prior year. Now with Penn Mutual, you can only go back 1 year, but they do allow you to at least go back 1 year. And they allow you to do that once you've paid your full amount that you can pay for that year. And so that's the only time that you can actually put in extra according to your contract. And you can actually see that straight on your dashboard. They call it a catch-up provision. So on your dashboard, you can actually see what that amount is. So if you don't put in the full amount, it's okay. Don't stress about it. Just put in what you can put in. Ideally, you would want to put that in before you do loan repayment, though. Yeah.
Kirsty, for Penn, if you say, for example, you couldn't put in your paid up addition and you didn't catch up, are you no longer allowed to continue to pay up the paid up addition in the years after? Or are you back down to just the basic? You're without do they disqualify you from using paid up additions future? Or you just
No. So I'm trying to figure out where to go with this. So if you don't put in the paid up addition, like let's say that you put in the minimum and then the next year you wanted to put in a paid up addition, you're fine to do that. You can put in just the minimum. You don't have to put in the paid up addition. Now, I will say that majority of your cash value, especially in the first few years, whatever amount you are putting in toward paid up addition, majority of your cash value is going to come from that paid up addition. So if you only ever put in the minimum, you'll still have cash value, but it's very slow to grow. And you're not going to be super thrilled with what's in there and the growth that's in there.
But so you're not penalized. You're not penalized for missing a paid up addition and not catching up. You can still put paid up additions in years 5 moving forward, say, for example.
Right.
Gotcha. That's what I was.
Now, one caveat I will say to that, every single one of you that have Penn Mutual, if you look on your dashboard, there's a place that's called, Shane, help me with this. I think it says Riders. Riders.
I can go. Yes, it is the Riders.
Anyway, it's Riders and something. It'll say Riders. It's on your left-hand side of your dashboard. If you click the little icon next to that in the top right corner and you open that up, it'll tell you if there's a catch-up in there. It'll tell you an amount like, oh, okay, that's how much I can put in from last year, and this is how much I can put in for this year, and it'll actually total it up at the bottom. Now, it will also say minimum paid-up addition amount, okay? So let's say that your paid up addition rider amount that you can put in is 10,000. What Penn Mutual does is they say, okay, if you're not going to use that rider, so if you don't use it for years, then they can take that rider away from you and not let you put anything in toward paid up addition in future years.
Ooh.
Okay. Now it will say on there what your amount is. So it's half of the amount. So if your paid up addition amount that you can put in for 1 year is 10,000, it's half of that amount. And that needs to be put in over a 5-year rolling period.
Mhm.
Okay. So, which by the way, also ends up being, if you're putting in 10% of what you can put in every paid up addition amount for every year, like, so if you were putting in $1,000 a year for 5 years, that also is $5,000, right? And so it will actually show you on that part, it will tell you how long your paid up addition period is good for. It like kind of kicks the can 5 years down the road every time you put in half of your paid up addition amount. So if you put in half of the amount 1 year and then the next year you don't put in anything, then you still have 4 more years to put in, to kind of keep kicking the can down the road, or they can take that rider away from you if you are not using it. So that's probably a complicated thing. And actually, Shane, I might have you pull that up if you want to pull up one of my policies so you're not sharing anybody else's information.
I can pull up. I actually have mine up already.
Okay. So yeah, do you want to hijack the screen real quick and we'll show you what that looks like? So it's half of your amount and it will give you a 5-year time frame. So if you're with Penn Mutual, now if you're with Guardian or Mass Mutual, there's an automatic like minimum amount that they have on those as well. And so you'll want to make sure that you're, putting in at least the minimal amount. So right here where it says paid up addition rider requirement. So this one is $5,861. And see where it says due remaining for remaining PUA rider payment requirement, and it says June 7th, 2030. So this policy application, or policy, the anniversary is on June 7th, and the last payment was probably 2025. So it already kicked the can 5 years down the road. So if you look at that date and you're like, oh, that's this year, then you might want to put in at least that minimum amount. And it will tell you like remaining amount required to keep the rider active. So obviously this account has been fully funded, and so it's not showing that you need to put anything in because it's already kicked the can down the road. So again, you don't need to put in the PUA, but if you don't put in the PUA and you do the minimum for like 5 years in a row, then you could be in jeopardy of having them say, hey, if you're not using it, we can take that off your account.
Yikes.
Now, see where it also has that catch-up amount right underneath that? So the annual premium loan. So that catch-up amount, if this account hadn't put in the full amount the prior year, then there would be an amount there. Instead, it's showing right underneath that where it says total amount paid during the current year. So that paid up addition rider is $10,731, which again, that number up above that rider requirement is half of that $10,731. So if you're not sure what your rider amount is or what your requirement amount is, it's always half. And so they say if you're not putting in at least half over a 5-year time frame, which again, honestly, this doesn't apply to people because people are trying to cram it as much as you can. But if you put in just the minimum for 5 years, you could be in jeopardy of having them take that rider off if you're not using it. So, and then if you're wondering how much you can still put in for the year, that bottom number says remaining amount that you can put in. So on this policy, you can put in another $991.61. So if you're wondering, hey, if I'm not going to violate my MEC corridor, how much more can I put in this year? That's where you can get that number as well. So, capiche, as my 9-year-old would say.
Oh, capiche, that's a big one for a
I know
9-year-old.
she doesn't know what it means. I was like, do you know what that means? She's like, well, I don't know. And I'm like, it just means like, do you understand?
Do you understand?
Like, get it? And she's like, oh, I didn't know that that's what it meant. I'm like, okay. Anyway, all right. So coming back to this. So there's, debt restructuring. So again, the security of things, like that's the first layer of the foundation. So you're going to first use it to refinance your own debt, give yourself a lower interest rate, and actually make some headway on getting that debt paid down. Now, once you get the debt under control, then you can kind of work on some of these other things, and in an ideal world, that would be the case. Now, sometimes you might be doing some debt restructuring and you might be working on some personal capital. That's okay too. But in general, if you are drowning in debt, please handle your debt before you try to go out and then start doing investments and start doing a bunch of other stuff, because you can end up kind of getting into hot water pretty quickly. And so we usually use the analogy, you don't want to give a chainsaw to a kindergartner. That's what this allows you to do. You can, get yourself into more trouble because you have the use of the funds, but please try not to do that. So this helps to kind of keep it in safety zone. Okay, so personal capital. What are some things that you can use for personal capital? What do you think we mean by that?
No, I zoned out for a second. Sorry.
Investments.
Okay, so this could be investments, which by the way, you can also kind of categorize this one as like business and real estate. This could also be investments. So yeah, personal capital. So in this case, personal capital is a little bit more, I mean, this is using it broadly, but in personal capital on the items that we have bullet pointed, it has, things like vacations or even like tax bills or like annual real estate taxes, like property taxes, for example, and then there's also income taxes. So anything that you have kind of like as a big expense. So think about what you normally put money aside for. Okay, so sometimes you're putting money aside maybe for like Christmas or maybe for vacation or maybe for taxes or maybe for, XYZ. So you can use it for those kinds of things as well. Now, why is that a good place to put it into the policy and then take it back out of the policy? Because those are probably things that you're doing on an annual basis or on a regular basis. So if you think about it, like use Christmas or a vacation. So sometimes people are like, okay, well, I kind of budget for $5,000 a year, let's say, for vacation. Okay, well, if you normally would have money that would just be sitting in a checking account because you're trying to like, okay, I'm going to put aside, $500 a month toward vacation fund. Okay, well, that $500 a month, where is it going? If it's sitting in a checking account, we want to have it sit in a checking account as little as humanly possible. So rather than sitting in a checking account, why not put it into your policy? And then when you have a vacation that comes up, you're taking a policy loan and taking it back out. And then aren't you saving again for the next vacation right away? So aren't you kind of doing the same thing by kind of like repaying back that policy loan? And then you're kind of like rinse, recycle, repeat. So that's a perfect example.
And as well that those funds are doing something for you while they're in the policy. Compounded.
Exactly.
Yeah.
But you can't pay ahead more than it out. So it would have to come out in the form of a policy loan. And then you would be paying it back. Because this tax season right now, I'm all over this right now.
Yeah. Yep. So, and that's the whole point, is that you can use it for whatever you want to use it for. But in this case, personal capital would be like, think about the big ticket items. And that's probably the easiest way to think of it. The big ticket items that you might normally put money aside to save for, rather than saving it in a checking account, having it be in your policy, taking a policy loan and then replenishing it and kind of putting it back. You're still doing the same thing. You're just using a different, more efficient vehicle by utilizing the policy for something that
But
way.
you don't take the loan out ahead, because then you're sticking the money back on a checking account. You just take it when you need it.
Exactly. Yep.
Right.
So the question was, where would you put capital? And capital in this case, in this regard, is any available cash, whereas the individual flows of cash that you have on a regular basis are what you want to use for this.
Yeah. Well, and a lot of this, if you think about it from like a big picture standpoint, the less you have in just a checking account, savings account that's like earning 0.1%, like it's different if you've got it in high yield or something like that. That's a little bit different of a situation.
Yeah.
But you're basically saying, hey, who controls and uses my money? Okay.
Right. So all of your recurring items are things that could be, that cash could be continuously utilized on your behalf.
Yeah. So, but I'm saying big ticket items because you're not going to be using this for your cash flow every single month. You're not going to be like, hey, I'm going to put my whole paycheck into here and then I'm going to take all my paycheck back out to pay my bills. Okay, that doesn't make any sense.
Yeah.
So
well, a big ticket
if you think of it like big ticket items.
Yeah, but you're talking
less often.
Over 4 figures, 4 or 5. Right.
Yeah, and to everyone it's a different number. So like what's big number to me is different for what's big number to the next person. And so like if you're thinking about this as just transactions that are not taking place every single month, it might be like quarterly or it might be yearly, it might be every 6 months. So another example of that would be like prepaying, like if like you get a discount when you're doing like on your car insurance, for example. Okay.
Right.
So if you pay for it up front and do 6 months, are they giving you a discount versus if you're paying it monthly?
Yes.
Okay. So you want to be able to do the math and kind of go, you know what? Maybe I still pay it monthly, but I pay it to my policy monthly and I get the discount of paying it annually with the insurance company.
Now you tell me I
And
just
those
paid for my insurance. Dang it.
well, and
Christy,
it depends on what kind of discount you're getting, right? Yeah.
are loan repayments treated differently than premium payments by the company? So, for example, when I make a premium payment, let's say it's my annual premium, let's say it's $10,000. My cash value only goes up by like 5 or 6,000. So when I make a loan payment, is it a dollar for dollar treatment or is it also discounted?
Yeah, and really it depends on which year you're in on your policy as far as how much of that paid up addition premium is going to go straight in. But essentially, most of it is going in essentially the same as if you're doing a loan and if you're doing a paid up addition. Once you're in about year 3 or 4, then it's essentially the same whether you're doing new premium or paying back a loan, it's essentially the same. It
I'm
might
not
be
sure.
off very slightly.
I'm not sure I understood. Does that mean it's a dollar for a dollar, or is it you put in a dollar and cash value only goes?
Yeah, it should be dollar for dollar either way. So whether you're paying back a loan or you're doing paid up addition. So if you have an example like where you've put something in, let's actually look at the dashboard, because one of the things that's nice is you can look at your dashboard and you can see what was the cash value the day before I put in that deposit, what is the cash value now. So
Christy, he was
Right.
talking about premium payment too. So
Yeah,
Right,
premium,
right.
premium.
Exactly. Yeah, like the paid up edition premium payment. Now, oh, okay. Actually, I see what you're saying, Dave. Okay, so the paid up edition premium, that's going to essentially all go in as cash value. The base part of your premium, you're going to have some of that's going to go to the cost of insurance and some of that's going to go into cash value. The longer you have the policy, the higher percentage of that's going to go into cash value. Yeah, that's a good distinguishment,
And
Dave.
then before
You're
10
right.
years, after 10 years, you're getting 100% of the dividend. And before that, you're getting 77%, did you say?
Yeah, and that's only on the loan portion. Yes.
Okay.
And so, yeah, so Walter, to your point, if you're putting in like if your entire premium was 10,000, some of that is the base premium, which is covering the cost of the insurance. So not all of that dollar for dollar is going to go in. On the paid up addition portion, though, it should be the same. If you're putting in paid up addition or you're paying back a loan, it should essentially be the exact same. Now, it might be slightly higher the further in the policy years that you are, because that paid up addition is kind of going to give you a little bit more than dollar for dollar versus a loan, it is dollar for dollar. So yeah, good question though. Okay, the third one on business and real estate. This one is a lot of times people already have a business, or they're maybe starting a business, or they're looking to do like investments. They're looking to do, something where they're looking for growth opportunities. And so this is a good base camp to be able to have that be where the funds could come from. And so you have, like, for example, let's say that you have a business that you already own and you're saying, hey, if I had $50,000, I could scale my business and I could increase my revenues by 150,000. So obviously anything that you're doing with your money, whether you're using the policy or not, you want to ask yourself the question of what am I paying out and what am I getting in return? And so in an ideal world, you'd have this be assets or things that are actually going to be growing and compounding even more. And so that's kind of the level that we're at here. So we kind of start with debt restructuring foundation. We've got personal capital on just kind of doing things a little bit more efficiently, trying to get some of those discounts. Another example, my girls needed braces. And so, and my husband's kind of funny because he understands this, but not to the same level that I do. And he calls me and he goes, hey, so the braces are going to be whatever it was, 3,000 or whatever it was for each kid. And he's like, how do we want to, they're asking how we want to pay for that. And I'm like, ask them if they have a payment plan and they have a 0%. And if so, how long is that for? And he's like, but hun, we have the money. Why don't we just pay for it? I'm like, ask them the question. And he's like, oh, that's right. Okay. So he asks them and they say, yeah, we'll do no interest, no payments for 12 months. And I'm like, okay, tell them we want that program. And he's like, okay. He's like, but why not just pay for it? And I'm like, because if I can use their money for free, why would I take mine out of rotation if I can use theirs for free? And he's like, okay, I get it. So
He's
that's another example of personal capital. Now, at the same time, too, I also said, ask him, I asked him to ask them if we paid up front in full right now, how much of a discount would they do? And they said, we don't do a discount. And so I'm like, okay, then we'll take your 0% option and we'll take 12 months to pay you and we'll do that one instead. So
The
if they
only
give
thing
us
that
a
might
discount, that
change
might
is your
make sense.
credit. That could change your credit score if you were trying to buy
Right.
a house or.
Yes, and it will affect your credit and it will affect your credit score. It will affect your debt to income ratio because if you pull your credit, they're going to say, what payments do you have outstanding? We don't really have payments because we finance everything ourselves for the most part. And so I'm okay with the 12 months of payments that are on there. I did the same thing for a surgery. I've done that multiple times. So if I can get somebody else's money for 0%, I'm fine to do that. You just want to kind of be reasonable about how you're looking at that. So
But Christy, now this is a little bit off, but you said that you have what is it, a health savings account. How does, doesn't, I mean, how does that play into any of this?
And we'll get into it another time just for the
Okay.
sake of time, but I will touch on that really briefly. We just went to the pharmacy and picked up some medications, and my husband said the same thing. He's like, wait, so are we using the HSA account or are we not? And I said, no, we're not, because we're getting a tax deduction by putting into it, but we don't necessarily need to use it, but we can use it later on, so let's just let it grow. He's like,
Got it. I understand what you're doing there.
But if we were in a tight crunch, would I use my HSA? Yes. So that kind of hopefully answers that kind of in a simplified manner. So there's that. But anyway, so the fact that you can use it is nice that you can, but you don't feel like you need to. Okay. With the policy on the legacy side, this is basically, and actually we came across this situation this week with a client where they had, I can't remember, like it was their mom or their dad who had recently passed, and they were the second parent to pass. And so they're in probate right now. And so she's like, when this is all said and done, then there's assets that are going to kind of pay off for my mom's estate. But for right now, I don't have the ability to, like, my mom doesn't have assets that actually pass to us that are not tied up in probate. And so therefore, I'm having to like come out of pocket for some of like the attorney stuff and some of like getting all this settled. And so I said, well, that's a good purpose to use your policy for something like that because you know that you will be replenished. It's just a matter of if and when. So may as well use your policy for something like that. So that's one for legacy. The second is that whatever you do not use, the benefit of the policy is that that all goes to your beneficiaries, whoever that might be, income tax free. So whatever that death benefit is that does not get used by you in this lifetime, whoever your beneficiaries are will receive that at some point. And so being able to, have the ability, like if you have assets, like if you think about what you might be leaving to your kids or your beneficiaries if something happened to you. So just kind of like mentally think about all of the different assets and what would actually happen. If you don't have a will and a trust, it probably will be stuck in probate. Okay. Now, what are your family members going to do during that time frame that it's in probate if you don't have a trust or a will? Well, they're going to have some working capital to be able to get them by while it's going through probate, right? So whatever they have coming from you in the form of death benefit, that is not going to be held up in probate. That's going to be funds that are released to them right away. So let's say that you have a home that you still owe on, but they received a death benefit from your passing of 500,000 and your home has a loan of 500,000. Okay. Now, if it's going to get stuck in probate, what are their options if if you didn't have the policy, what are their options?
I think they're going to get foreclosed on, it seems like. They're going to lose that house. It sounds like to me.
Probably, because here's what happens. If you don't have that property in like a trust, then how does a dead person give you rights to sell that property?
Or make payments on it. How do you make payments on it that it's not?
Now, just so you know, mortgage companies usually aren't going to complain if you're making the mortgage payments on it. But how are you going to pay for that if you have no other assets? You're going to have to pay for it out of pocket. So just these are some things for you to keep in mind for your beneficiaries. If I passed away today, what would get held up in probate and what would they have liquid to kind of get them by while it's going through probate? Or would probate be avoided altogether? And so this helps you on an estate planning standpoint that even if it was going to be held up in probate, if you've got a $500,000 death benefit and you owe $400,000 or $500,000 on your home, couldn't they actually make that payment to the company or make like a year or two's worth of payments to the company to avoid foreclosure and still have the asset that can be untied up and then still have everything that goes through the probate courts? They have enough funds And so it allows them for more options instead of just being like, oh, well, that really stinks that dad intended to leave us the house, but because it's not in anyone's name but his, it's going to get stuck in probate. And we can either come out of pocket ourselves and pay the payments, which is going to be a financial strain on them. Or if there are other assets that are not in probate, that would come to them and hopefully they can use that while it's going through probate. So just keep in mind the legacy side of it is huge and nice. And so whether you have a trust or not, that will help them to be able to avoid some of the pitfalls that probate is going to put the pressure on them during that time frame while that's getting settled through the courts. And it gives them some more options to where they're not feeling like they have to do, quick fire sales on things that they own because they've got to be able to take care of, their parents' estate that they own $100,000 on it, but yet it's worth $1 million and they don't want it to go to foreclosure, right? So you want to be able to make sure that you have those protections in place for your heirs too.
But there are other debt besides a mortgage on you. You have to pay your parents other debt before you get anything. So there's other debt to consider too.
Exactly. Yeah. So that's why I'm saying look at the whole big picture and just say, if I passed away, what kind of pressure is that going to put on my beneficiaries? And what's going to get tied up in probate? What's going to get released to them? And how is that going to look for them? So just kind of be aware of that. So this is just kind of talking about like phase one, restructuring the debts. If we look at the liabilities and how much is actually going to external banks, what we're trying to do instead is have this go into the policy, recapture the interest, pay off the liabilities, and have this kind of be in your internal system instead of just leaking out to external banks. So again, this is kind of giving examples. So we've got car loans. So sometimes it makes sense to refinance car loans, sometimes student loans, credit cards. So those are some examples on that side. Then if I click the right button, this is another one, the opportunity cost of paying cash. So financing lifestyle without interruption. So the fact that you're able to have your policy that continues to keep growing, this allows it to have uninterrupted compounding that happens so that as you have opportunities that come up or you have, negative impact things that come up, it allows you to be able to have the option to be able to do both while the policy is still continuing to grow. So these are some kind of operational kind of things that we were talking about before. So major purchases, you've got cars, vacations, weddings. So this is like on that personal bucket that we were talking about before, personal capital, but this is also unforeseen events. So medical liquidity, you've got education, tuition, got weddings for kids, whatever the case is. So those are some kind of things that you're basically saying, hey, I'm going to let this keep compounding while I'm using it for all of these personal capital uses. This one is kind of like the third phase, which is on, like I mentioned this before, like on smoothing out the payroll. So if you got ebbs and flows of your income, you can let the policy help you to kind of stabilize things when you have down months. So if you're a teacher and you don't have as much coming in the summer, you might go, you know what, during the summer, I'm going to borrow from the policy a little bit, and then I'm going to replenish it throughout the year when I'm on my school schedule. So that's kind of an example of like payroll smoothing. Or if you're doing sales and you know that, hey, I've got a big commission check that comes in or a bonus check that comes in April, I'm going to do this to kind of get me by in the meantime. Quarterly tax payments, inventory and marketing, equipment. So, and that kind of gets a little bit into the business side. So if you've got things that you have, working capital needs for, then this is kind of like on the business and real estate side. You guys, I'm flying through these, sorry.
We asked a lot of questions.
This one is on real estate acquisition and velocity. I'm probably going to table this for another day because I feel like real estate can kind of go down its own rabbit hole. But basically understanding that the liquidity that you have in your policy allows you to take advantages of opportunities you might normally not be able to take advantage of. So the fact that you can pay cash for a house. So this is one thing that I used to do. This is like, I'm going to kind of paraphrase this in a nutshell, but one of the things I used to do is as a real estate investor, I would always give a seller 3 offers. I would say, here's my cash offer, here's my middle offer, and here's my highest price offer that I want you to sell or finance it for me. And so I would give them all 3 and say, hey, you pick which one you like the best, and then we'll kind of use that as our starting point and start the negotiations from there. And so the fact that I had a policy and had the ability to have cash that I could pay for a property was a nice vantage point. So it's no different than if you go into a car dealership and you say, hey, which is going to give me a better deal if I pay cash, or just like the example I used with my girls' braces. Okay, which is going to give me the better deal? If I pay cash, do I get a discount? If I finance it, what's that look like? Like, so you have more control and an ability to improve your finances because of the fact that you have liquidity and control, which is one of the biggest things that the policy gives you. So you can use this for like rehab funds, which normally you'd have to go to like a hard money lender on. You can use it for bridge loans. You can use it for down payments. And so it helps to just make your system that much more efficient. The fact that you're able to finance these things on your own and have yourself become the banker instead of having to use hard money lending and have to worry about like seasoning of funds and them needing, a financial strip search to be able to give you a loan. They're worried about debt to income ratio, like you mentioned, David, earlier. And so when you are financing things yourself, you don't have to do that. Now, just because you don't have to doesn't mean you shouldn't do that either. So if you're going to use your own funds, you should treat your money with the same respect that a lender would treat it, and that helps to kind of keep you out of hot water as well. Yeah, DC, yeah, this is kind of like advanced lending strategy. We'll kind of save that for another day. This is another one I'm just going to kind of close with one other one after this. So this is one of the things that we talk a lot about. So when you go to retire, if you've got your portfolio that kind of does this right here, so think about like 2008, this is kind of like what happened, right? So if you've got your funds and your accounts that are doing this, and then all of a sudden there's a market crash, and yet you're needing to take out, you've got it depleted a lot faster than you thought. You maybe thought it was going to last you to here, and it's only lasting you to here because of the market crash and you taking it out at the same time. When we do the policies, it allows you to be able to say, okay, when there's a down year, maybe I want to take out of the policies instead and use that for my income so that I can let this kind of stabilize a little bit. And so it allows you to be able to kind of create your own volatility buffer by being able to take out of steady eddy funds, which is the policy. Now, if you're not in a down year, you could also drain out of both accounts at the same time and say, okay, I'm going to take out of my 401k and take out $100,000 a year, and I'm going to also take $100,000 a year out of my tax-free account, which is my policy. Then what are you doing on your tax bracket? Are you taxed on 200,000 or 100,000? If you're taking out of your 401k 100,000 and then your policy 100,000 a year, how much are you taxed on? 100 or 200?
100.
100. Because is the policy taxable?
No.
No.
Not if it's done right. Right? So it should be done right. And so it helps you to be able to lower your tax bracket, which means you retire earlier, you retire with more, and you have less that you're leaking out to other banks on interest that's lost to you and on taxes that are lost to the IRS and lost to you as well. So those are the two biggest things that we try to tackle, is being able to refinance things so that you're not losing money to the banks, and also recapturing things and utilizing smart system stuff to help you to lower your income taxes so that way you're able to be in lower tax brackets and hold on to more of what you're earning and hold on to more of what you saved.
Christy, you have mentioned in here about like a teacher that doesn't have off time like in the summer and they might want to use this for their month. So this might be a dumb question. I don't know. But say, is there a way that like if you need extra income, you say you use the policy to kind of fill that in, but can you have it so that it pays you monthly? Like what if I need $5,000 to get me through the next month, I have to take the whole $5,000 and stick it into a checking account, or can the policy pay me back
you can
$1,000 a month for 5 months?
Yeah, you can set it up however you want to. So you could do a lump sum, or you could do, you can do however you want. There's a lot of flexibility on the policies on paying into it as well as taking distributions.
So we could set it up so that it pays our estimated taxes at that time.
Well, it's not going to pay it directly.
Right, come to me so that we can take it out. Like I'm going to set up a loan so that each quarter that it goes to my bank account so that I can just pay them. Yes, sort of, no.
Yes and no. So it's more manual than an automation like what you're talking about, but you can do it as often as you want.
Okay.
All right, I'm going to leave it with this one just because I think this is a good summary. So this is kind of like the complete sovereign ecosystem. So what we're basically saying is we've got this base layer right here which is your security. And again, we talked about like focusing on debt structuring. If that's the layer you need to focus on, if you have that, that's kind of your focus point. Okay. After that, then we've got the business and personal liquidity, which is your control. So the fact that you control it. And then we've got the real estate and investing business, kind of the velocity side. And then we've got the legacy and estate planning, the perpetuity. So, keep in mind that the infinite banking concept is not a product, it is a process. So it's a system. And so the more that you understand the system and understand the relationship of money and how to be able to improve your overall financial economy, the better off your system is going to be. And so hopefully you guys got something out of it. Sorry, I know that we went over a little bit, and it seems like we always go over, but there's always more content than what we have time for, I feel like. So if you guys, Shane, thank you for putting the poll up. If you guys can fill that out before you guys exit, I can stay on for about another 5 minutes if you guys have any other last minute questions related to policy uses or funds. Otherwise, Shane, if you have that page where it has just kind of like the list of the items, I'm going to trade places with you. And these are just some kind of examples that we've already touched on. But if you want kind of like a list, sometimes that helps to jog your memory where you're like, oh, I didn't think about using it for that. That might help you too. Thank you, Rip. Always glad to have you. All right. So this is kind of like the start of it. So debt restructuring. So moving car loans into the policy. In other words, refinancing it through policy funds, refinancing student loans, paying off credit cards, replacing high interest, refinancing with your own system. So if you guys want to screenshot that part, or maybe we can even put that in the chat, can we?
Can you upload the document to chat? That's a Word document, so you can upload the document into the chat.
Oh, Shane, you're awesome. You actually took it and created its own document.
I did.
Okay, thank you. This was part of a bigger document, so.
Yeah.
Are you able to drop that into the chat?
I have to save it first.
Okay. So we'll save that. If you guys want to stick around for a second, we can drop that in.
Here, let me stop sharing for just a sec because I'm going to be going into
Yeah.
a few different screens here.
Mm-hmm.
And obviously, this is not a complete list. My dad and I, when I first started working with him, he and I actually just for fun one day, we were like, let's just list all the different things that like we've used it for, clients have used it for. And within about 10 minutes, maybe it was more than that. It might have been 15 minutes, but within a really short amount of time, we had a list of over 100 different things.
Oh my gosh.
So when we talk about that it's infinite, that's why. I mean, it's like every day there's a new use of somebody that you talk to that goes, hey, I was thinking about using it for this. Could I use it for this? Or how would I use it for this? Like, yep, absolutely. Like there's so many different cool things you can do with it. So it really just depends on your own financial situation on what makes the most sense. But I do like the visual of having the, like the security and debt restructuring, kind of like having that be the foundation, because that's one thing that Nelson talked a lot about is slaying the snakes and dragons first. And that's what he was referring to, is basically saying, hey, those things that are like drowning you, let's take care of those first, because once you're kind of got your head above water, then we can kind of look at the rest of the things from there. So if that's where you are, let's slay the snakes and dragons first before we kind of move on to the next levels and kind of work your way up. So